Good evening. Welcome to this How Will the Election Results Impact Your Finances webinar with Lumon on SJB Global. My name is Jonathan. I'm a currency specialist here at Lumon, an international payment provider. Thank you for joining us for this evening to discuss the results of the recent elections and how this could influence your personal finances and financial markets ahead. So tonight I'm joined by two experts from SJB Global. We'll shortly hand over to them for their introductions. But what we want to do is make this evening as interactive as possible. So you should see a question box, audience, in order for you to raise any fresh questions you might have for this evening. We've had quite a few questions submitted beforehand, and we'll certainly be working our way through those. Some of the more common questions that we're seeing people asking after the recent elections. And we may not get through all of the questions this evening, so there will be a recording of this that will share the evening's talk, but we'll also give you the opportunity to speak with our experts more readily after the webinar. It's quite difficult to cover all the points sometimes in real detail over the hour. So yes, thank you audience for joining us. I'm now going to hand over to my fellow panelists. Jake, if I can hand over to you, founder and CEO at SJB Global.
Yeah, thank you. So yeah, as you mentioned, I'm the founder of SJB. We've got two separate entities, a global entity and the US as well. I've been in finance for 10 years. And spent most of my life as an expat. So it seemed like a logical move to go into this role to help expats in a similar situation to myself. So I'm looking forward to discussing today's webinar on the changes with the UK elections.
Fantastic. Thank you very much, Jake. And over to you, Lewis, Senior Financial Advisor at SJB Global.
Thanks ever so much, Johnny. Yeah, as mentioned, I'm one of the senior financial advisors with the firm. I've been working here for quite a number of years since the inception of the company, but prior to that, I actually worked with Jake in Canary Wharf, where we were equity traders. So yeah, quite a lifetime ago now, but it was over 10 years ago that we started there. I have spent time, like Jake, as an expat, living in France, Switzerland and Spain, but sadly found myself returning to the UK where the weather's not so good. But yeah, I've seen both sides of the equation, so the expat side as well as those returning to the UK after a period abroad.
Perfect. Thank you very much, Lewis. And yes, myself, Jonathan, well, I've been here at Lumon for 15 of our 25 years of trading. Last year we were trusted with about £9 billion worth of currency to handle for our clients. So as well as hosting these webinars and trading and looking after my clients and some of our partners, I'm also a market analyst. I'm very interested in the FX markets, and I've been quoted in a few newspapers, and once even appeared on BBC discussing the referendum. So one of the things we like to do in these webinars is actually find out a little bit more about you, the audience. So I have just launched a poll for all of those watching, just to let us know where you might be joining us from. It's quite helpful for us to get that information. Certainly from a currency perspective, there's different currencies to consider and different global implications of some of the points we're going to run through. So thank you very much everyone who's answered that poll. A fairly even split between the UK and Europe, and then certainly some clients from the US, as we did expect. So yeah, thanks very much everyone for joining us. As I say, you do have the question box there to submit any live questions. Right, why are we here? Well, it's to talk about the recent election, what could be in store ahead. From the FX markets, it was a bit of a muted reaction, just showing what was sort of priced in, and we'll certainly discuss that in a bit more detail. But Jake, Lewis, let's turn over to you both for your insight into the financial things and how this is really going to affect our clients' finances. Jake, if we start with you, one of the topics we talked about was tax with the Labour government, certainly a point many people wanted to discuss. Now, they said they weren't going to raise VAT, income tax and national insurance, but they were talking about inheritance tax. There's certainly been some questions around that. What's the outlook for inheritance tax and how would that affect UK citizens resident overseas?
So the actual inheritance tax rate has been frozen for many years. There was a few questions surrounding how it impacts people overseas. So just to explain how the current structure works, the UK works off of a domicile of choice origin. Sorry, a domicile of origin, which means it's based on where you were born and where your father was born. The Tories have said that they've discussed to put in place that it moves to a residence-based system in 2025. So this means that then your UK-based assets will still be taxed in the UK, but the non-UK-based assets won't be. And to qualify for this rule, you'd have to live outside of the UK for 10 whole years. Now, this is big news because it is very complex to work out what your domicile status is. And one example I can give you is there was a famous Welsh person that spent his whole life in the US, pretty much never lived in the UK, I think only a couple of years when he was a child. And then when he passed away, he decided to be buried in Wales with a Welsh flag on his coffin, and that was enough for HMRC to turn around and say, well, actually, you're a UK domicile, even though he spent all of his life outside of the UK. So what you actually have to do, or have had to do, is cut all ties with the UK. So simple things such as having UK shares could be enough to tie you to the UK. And then let's say, for example, you left the UK, you decided to reside in America, where you decided to take domicile choice as the States, but then 10 years later, you decide to move to, let's say, Panama. Because you've then moved country again, your domicile status resets back to your country of origin, which would be the UK. So even though you've now spent over 10 years outside of the UK, you're now back under the UK regime. So it becomes really, really complicated. And just to make things even more complicated, to explain my exact scenario. So my partner is from Colombia. When we had kids, we did a civil partnership that was only recognised in Andalusia, Spain, wasn't recognised with the UK, which actually means if you're not married and you have children, your kids take the domicile status of the mother. So the mother being Colombian means that my kids are actually Colombian domicile. They've never been there. They have a British passport and only ever lived in Spain. So that creates a very difficult scenario for people to understand where they are actually domiciled, especially if you live outside of the UK. And another complexity to add on top of that is in the UK, if you and your spouse are both UK domicile, you get a spouse exemption. So you can pass assets between each other without incurring any inheritance tax at all. But if the spouse is non-dom, which in my situation, my spouse is, there's a limit of £55,000 that can be passed on. So this creates real difficulties to find out what these limits are for individuals, especially people outside of the UK who often have more complex situations like I do. So the most important thing you need to work out though is what is actually taxed for inheritance tax. So it's assets that fall under your estate. So this includes property, cash, general investment accounts, ISAs, valuable items. That's often overlooked. You could have valuable items that are valued at an extremely high amount. That falls under your estate as well. And then life insurance, if you haven't put your life insurance in trust, then this also falls under your estate. Assets that don't fall under your estate for inheritance tax is pensions and assets that are within a certain type of trust. So in the offshore market, a typical trust that people could use for IHT planning would be a QNUPS. These assets do not fall under your estate because the owner is the trust. So careful planning is very, very important, but what you don't want to do is plan based on potential changes that are going to come into play, because what we need to do is wait for the elections, for the budget to happen, to see if in 2025 this change does happen. I hope it does, because it affects me personally. So if we move to a residence-based system, happy days, I'm all for that. But the only thing that you could really do to plan now is sell your UK assets, because if this change does come into play or it doesn't come into play, UK assets will still be taxed in the UK. So if you sold those assets and there wasn't a change to the system and you ended up taking a domicile choice outside of the UK and you had no ties to the UK whatsoever, then it's a win-win. So that's the only real thing that I could think of that you could plan for in advance now. But the best scenario would be to wait until the budget does happen to see if these changes do actually take place.
Excellent. Okay, thank you very much there, Jake. Lewis, let's turn to you. So we're talking about really, the change in the market sort of overall. How would you say, we've got a question here just about managing volatility. How would it be best to sort of manage your volatility at the moment and still maximize returns, given some of the changes that we've had happening?
Yeah, very good and very valid question. Certainly one that's on the lips of many of my clients, and they've been asking similar. I mean, one of the key things to remember is, generally speaking, an election doesn't move markets too much. Although we did think that Labour win would be a net positive, and there were certain signs that lent itself to Labour being positive moving forward. And we have seen a bit of that effect in markets, but on the whole, elections are just background noise. Some of the features and some of the policies that they looked to enact and put forward might have more of an impact on certain sectors of the market. But generally, on the whole, yeah, elections are just things that do take place. And I mean, in this case, it was slightly different. The election result brought about a new Labour government, so a change in government does bring about a bit of change. And it was also a landslide victory for Keir Starmer and the red side of politics. So, I mean, it's going to be interesting to see what changes with the new government and what kind of policies they're going to enact and bring forward. But I do think we'll likely see more of an impact in stock markets as well as property markets. For bonds, it's pretty much business as usual. You're likely to see more of an impact from Bank of England rate decisions that are upcoming on the 1st of August. But realistically, we're seeing that the only way for rates to go over the medium term is down, and that would spell upside for bonds due to the inverse relationship that they have. So to best manage volatility and to see the returns that people are looking for, I think you adopt a multi-asset approach. So it's something we've been doing for clients for a very long time now. And what you then build into the portfolio is an equity portion of the portfolio. And then that covers the growth element, but then you can also quite comfortably now position bonds in the portfolio for those steady returns that they are likely to see in light of interest rates coming down. One of the real key things that I think is going to be a bit of a change, not so much again from the election, but more just looking at markets overall, the next decade is probably going to differ somewhat to that of the past. So we've been talking to fund managers and investment advisors like us, and the consensus among the market is US equity valuations are perhaps towards the top end, where they have been a driving factor in growth for many, many years. But other areas might now also pick up a bit of the slack, and it might not rely so heavily on North American exposure to drive the growth, but actually areas like Europe and emerging markets are areas that do look particularly attractive, especially when you look at the UK market. It's a market that has arguably been underloved and undervalued for a very long period of time. So last month we held an election that was, we held a webinar that was pre-election, and we did say that a Labour win is a net positive for markets. And again, we talked about how the FTSE 250 would likely see more of an impact because it's more domestic, whereas the FTSE 100 is made up of more international exposed companies. And again, true to that analysis, the FTSE 250's increased circa 2% since the 4th of July. Again, the conversation last month around house builders seeing a bulk of that increase has rung true. Labour set to build 1.5 million new homes over the next 5 years. So I think moving forward, UK assets become more attractive. A landslide victory for Labour means that there's relative stability in the UK. When you compare that against things like in France, what they've been going through with their own snap election, as well as the Tory government that has periods of multiple leaders over a short space of time. So I think that, yeah, we're going to see a bit of political stability, a bit of confidence returning to UK markets, perhaps some bridges being built between the UK and the EU. I'm not saying we're going to join the EU again. I don't think a reversal of Brexit is on the cards, but certainly a better relationship perhaps with the EU under a new Labour government. Outside of domestic markets, I think we're looking forward towards Q3, Q4 outlook being more dependent on A, the budget, but also B, Federal Reserve, Bank of England rate cuts and when they will come into play. So the US at the moment almost fully pricing in a cut at the next meeting, and the economic data and the inflation figures are showing signals to support that cut, whereas in the UK rates are sitting at 5.25% and they can't stay there forever. I mean, it's been quite negative towards the property market as well as equity markets, and that increase in interest rates caused problems with the bond markets. So yeah, we're probably going to see over the next couple of months a rate cut. It's 50-50 as to whether that decision will be made in August or whether they will continue to hold. My personal feeling is that the UK will cut rates by 0.25, and my hope is that we reach around 4.75, 4.5 by the end of the year. If we do get there, again, certain sectors will see more of the benefit, but it just comes back to that age-old diversification is a strategy designed to mitigate overall risk, have your capital spread over a number of different sectors and across a number of different geographical locations to try and plateau out any volatility, manage that risk and still see returns to the upside.
Excellent. Yes, that interest rate outlook certainly is quite interesting. And I know I'd add from a currency point of view, sterling's been better supported since the election as we predicted. So no major change on the actual result. But as we mentioned, a strong Labour win, net positive for sterling, just a bit more confidence, removing some of the uncertainty that's been out there. And of course, all eyes on the Bank of England, like I say, 1st of August, they'll be meeting, and it seems like it's a bit of a 50-50 at the moment, really, with the interest rate decision there. You know, there's arguments for and against the cut, and that's actually where you can see market movement. I was talking to a client today about how potentially we can argue next Thursday's got more potential for movement than we had certainly on the day of the election. It was very, very muted for sterling, euro hovering really around the 118 mark. Whereas, say, next week with the Bank of England, with the market being unclear which direction things are going to go, as I say, that's where you can begin to see the movement, because essentially half of the market is proved wrong and has to adjust position according to whether they've held or cut. So, yeah, certainly from a currency point of view, that's going to be quite interesting next week. Right, Jake, let's turn to you. Well, a little bit about currency in this question, actually. Back to pensions. We've had a client submit a question. Can you work alongside my pension provider to move my investment from pound to euro? What are your thoughts on that? Any changes from the election?
Yeah, so just to explain, so first of all, pension is a bit of a vague word because there are different types of pension schemes and you may be able to do it and you may not be. So just to break the three options down, first of all, you have a UK pension. So this could be a defined contribution scheme. It could be a UK-based SIP, could be a workplace pension scheme, private pension scheme, tons of names for it, but it's a UK-based pension scheme which was set up for a UK resident. So this always has to be in GBP, the platform has to be in pounds, and the investments have to be domiciled in the UK. And the way you can see that is every fund has what they call an ISIN number. So it's almost like an ID code, and it has to start with GB for Great Britain. So if you have a UK pension, there's absolutely no way to do that. But what you can do, and two options are available if you're outside of the UK, is you can go into an international SIP, or you can go into a QROPS. So an international SIP, it is still a UK-based scheme, so it's registered with HMRC, but it's available for non-UK residents. And the difference with an international SIP is the platform, so the place where you have custody of the assets, where you can buy and sell different investments, that can be in a different currency, but the SIP still has to remain in pounds. So think of the SIP as the administration of the trustees, has to be paid out in pounds, but where you buy and sell the investments, that can be in a different currency, which means you can actually buy a fund outside of the UK. With the QROPS, you can have the QROPS, the fee in euros or pounds, and the underlying platform can be in any currency, the underlying investments can be in any currency. Sometimes there could be a restriction that you can't buy UK-based investments, but what you want to do, so in this example, the question is, can I move my pension from pounds to euros? What you want to do is you want to make sure you're investing your money based on where you're going to be spending your funds. So if you are going to be living in Europe, then it would make sense, for example, to have your money in euros if you're happy with the exchange rate. But what you always want to do is you want to have the platform and the funds in the same currency. And just to give you an example, I took over someone's QRops that was with a competitor years ago. They were living in France. The pension was set up in pounds. They were retiring in the UK, but the investments were based in Australian dollars. The client had never even been there. So I asked the question, why is it invested in Australian dollars? And apparently the advisor was taking the currency risk, thinking that, for example, Australian dollars was going to do better than the pounds. That type of move makes no sense, because you don't want to take on an extra risk from a currency point of view if you're not going to end up spending money in that currency. But with a SIP, it always has to be reported to HMRC in pounds. So that's why I said the UK SIP or the international SIP is always reported in pounds, even though the underlying platform can be in a different currency. And that's where we can adopt a strategy with Lumon, for example, where we can send the money to Lumon in pounds and then convert it into the currency of where you're going to need the funds, i.e. euros or dollars, at a favourable exchange rate. Because what you don't want to do is, let's say you're living in Europe, you want the money in euros and you send the money from the SIP, which is always paid out to the SIP in pounds, into a euro account, because then you're going to lose money to the exchange rate. So you can, and this is trustee dependent, you can then send the money from the SIP provider to Lumon and then convert it at a better exchange rate. So just to give one example as well of a client that I had, they were European resident, they were retiring in the US, and they had UK pensions. So for here, the question is, what currency are we going to put those assets in? It's not that easy, because what you have to do is review all of your assets. And if, for example, you are going to end up in the US and you may spend 1 month out of the year in the UK, then you're going to want most of your money in dollars and then some of the assets in pounds. So things like state pensions, you cannot change the currency. If it's a UK state pension, it has to be paid out in pounds. If it's a US state pension, it has to be paid out in dollars, and so on. Investments can change, but you would incur potentially capital gains tax if there are unrealized gains. And then pensions, if they are UK based, you can move it into international SIP or a QRops and potentially change the currency. So it's about looking at all of your assets as opposed to just looking at the pension and deciding, I want to move this from pounds to euros. You need to look at all of your assets and see which ones you can change to see if it actually does fit into your overall picture. So with that question as well, just to discuss the currency part, I'll just pass it over to you, Johnny, and just explain maybe some of the forecasts that you envision for the pounds, euros, or pounds, dollars.
Absolutely, no, and thank you for that and explaining that. Yes, absolutely, it makes sense, doesn't it, to move your money into the currency that you're going to be using. But if you're not, then of course the actual money transfer side of things is very important, and we can absolutely help with that. One of the key reasons dealing with us would be preferential rates. We can demonstrate savings over banks and certainly other sources given a fair shot. So in terms of the outlook at the moment, if we're talking about pound euro levels, and by the way, pound euro levels, we have risen to some of the highest points in almost 2 years. Last Wednesday was a real peak. Inflation number coming down in recent months for the Bank of England, actually at their target of 2%. But one key thing is services inflation. Inflation in the service sector is still quite high. And actually, what they're saying is to now cut interest rates. This is one of the arguments against cutting rates at the moment, would just fuel that even more and could push up that services inflation. Services accounts for about 80% of the UK economy, and to start putting up prices, could actually have, a negative effect. It would push that inflation number up higher if the economy was to get a big boost from these interest rate cuts. So despite that, there is, as Lewis and Jacob both pointed out, this expectation interest rates will be coming down for the UK. And what that does to the pound euro forecast over the next few months, we do see a downward trend. Now, how we analyze this, we look at the research of about 50 different banks to try and compile all of the different forecasts together. And it gives us quite a wide range. If we look at the next 3 months on pound euro levels, where we've just been over 119 once again today. Some of the lows we're seeing, Commerzbank, the German bank, they're taking their forecast in the next 3 months down to just below 115 to 114.90. Some of the more optimistic forecasts, I mean, you've got JP Morgan, the American investment bank, and Nomura, Japanese bank. They're both over 120. Nomura looking at 121.95. This is on pound euro over the next 3 months. Now, the average is just below 118. So out of these 50 different sources over the next 3 months, you actually see the rate a slight decline, as I say, down to 118 from the current 119. So that's where the market forecasts are taking us. And actually, if we take that out a little bit further over the next 6 and 12 months, that average does come down a little lower. It takes us to 117.60 over the next 6 months, and then 117.30 over the next 12 months. So why is there this sort of decline in pound euro expected? Well, it is to do with expectations that the Bank of England will be cutting interest rates ultimately, and we are going to see sterling weaker. There are absolutely forecasts for the European Central Bank to be cutting interest rates as well. They're forecast to be cutting in September, but a lot of that has already been priced in. The euro has been quite weak this year. It's lost ground against both the euro and the dollar. So we are seeing some of that weakness already priced in for the euro. Now, that doesn't mean we won't see changes. These are just forecasts, but they are what we call our intelligence market reports, rather than just looking at the analysis of, say, 1 or 2 banks. We look at, as I say, 50 different banks to try and come up with that average forecast. So yes, in answer to the question there, we do see a slight deterioration in the rate over the next few months, but there is so much out there that could change this. These interest rate forecasts are actually changing all the time according to the data. Of course, we've mentioned we've still got the French political situation to settle. At the moment, it's still a stalemate. It's a hung parliament. It's not quite clear which direction the French legislative setup will be, and that could definitely have an impact on the euro. But yeah, all in all, a very good time for buying euros with pounds. Now, just to stay on that point, because we did have another question really talking about the pension impact for pound euro levels and what we'd be looking at with any sort of transfers there. And I mean, perhaps Lewis, if I come over to you, are there likely to be any impacts on the lifetime allowance for a transfer into the EU from pensions?
I mean, it's a good question, but certainly interest rates won't have an impact on the ability to transfer one's pension. It might have an impact on the decision whether you transfer your pension. And again, by working with Lumon, we can refer clients across to setting up an account. And if they have got pensions that they're looking at transferring over into the EU, it might be a good conversation for them to have with their dedicated account manager, and they can talk about future forecasts on currency and whether it's a good time to either lock in a rate or whether it's a good time to actually move some funds across and take advantage of the attractive rates that are currently there. We are seeing changes, however, to, I mean, a lump sum allowance is something which has been brought in to replace the abolished lifetime allowance. So some of those changes are taking place. So the lump sum allowance just replaces the tax-free cash element under the lifetime allowance. So prior, the lifetime allowance was set at 1,073,100. And the lump sum allowance is just very simply a 25% amount of that. So it's 268,275. There are some things that Labour can enact that would impact this lump sum allowance. There are talks about, is it going to be frozen and then people would be subject to fiscal drag and they'd be penalised that way? Or is there grounds for them to reduce it from 268,275 down to a flat 200,000 or even 150,000? So there's a lot of things and a lot of moving parts that more will become apparent with the upcoming budget that's expected this autumn. So yeah, it's certainly something which we're keeping an eye on, and yeah, we'll relay information back to clients as and when it becomes more apparent.
One thing to add there as well is you can, if for example you are near the lifetime allowance that would affect your lump sum, you can actually apply for fixed protection. So that's something that you can still do today. It's called Fixed Protection 2016. So you've been able to do this for the last 8 years. And that means it goes up to £1.25 million. So that means you get 25% up to £1.25 million as opposed to £1,073,100. The other impact as well is the death taxes on pensions. So when you sort of the bit they abolished was if you were to pass away, sorry, if you were to take money that was above the lifetime allowance whilst you were still alive, so taking funds, if it was taken as income, you were taxed at 25%. If it was taken as a lump sum, you were taxed at 55%. And then when you reach 75, your whole pension was then tested against the lifetime allowance. So that's been scrapped. But what they have introduced is when you pass away, your pension will be tested against the lifetime allowance. So if you are above, then all of that money will be taxed at your marginal rate and be deducted before it's received by your beneficiary. So it's really negative, because before you could have paid the lifetime allowance at 75 years old. You live until whatever 90, 95 years old. It grows significantly more. That money gets passed on to your beneficiary. They can pass it on to another beneficiary. It just passes from generation to generation without any future inheritance tax. Whereas now, it's not just taxed at 25%, which it was at 75. It's taxed at the beneficiary's marginal rate, which is a much higher rate of tax. So that is quite negative, and it does sort of mean, because they got rid of the lifetime allowance to try and incentivize people to still pay into their pension scheme if they are above the lifetime allowance. But it has the same effect, because if you're then going to be taxed later on, because the reality is no one is aiming to spend every single penny from their pension before they pass away, because nobody knows when they're actually going to pass away. So you have to plan for the unplanned without actually knowing when that day is going to be, which means that if, for example, you've spent £1 million in the first 20 years and you've still got £1 million, all of that £1 million is almost going to be above. So yeah, it is a negative, and they sort of painted it in a way that it made out like lifetime allowance was abolished, but they're still going to make loads of money from the new changes that have been implemented. It just looks like it's better.
Excellent. Okay, thank you guys. Some good answers there. Right, Lewis, let's sort of come back to you. We talked about interest rates quite a lot, but we're getting a lot of questions on them. Obviously, it's very important for investment. Talking about interest rates getting below 4% again. When do we think central bank rates will get below 4% again with the current downward trends?
Yeah, I mean, it's a difficult one to answer. There's so many moving parts and so many things that could impact that between then and now. So we tend to look at smaller rate cuts on what it's going to be by end of year and what it's going to be moving forward. But I mean, as I mentioned earlier on in this webinar, Bank of England are set to sit down on the 1st of August. Most predictions have the rate cut as a 50-50, bit of a coin flip. 17th of July, we saw consumer price index remain steady at 2%, and that meant there was no change from May into June. Now, you do also have CPIH, which is consumer price index, which includes occupier housing costs. And that also was held consistent with the May data at 2.8%. So, I mean, this lends itself quite nicely to rate cuts, but some bank decision makers are wanting a little bit more evidence and may be prepared to wait until September 19th, which is when they sit down again to decide. So last time they sat down, we talked about this in the previous webinar, but it was right before the election. There was a vote of 7-2 in favour of holding rates, and they held rates steady at 5.25%. Now, it was probably a little bit influenced by the election and not wanting to rock the boat and not influence voters. The election was in full swing. I think the previous rate decision was about a week before the election date. So now we do have a clear winner, and that same factor isn't hanging over them. We might see a shift. The other thing to consider, we actually, interestingly, have got a new voting member. So Claire Lombardelli is replacing Ben Broadbent, who he previously voted to hold rates. So again, it's quite an interesting factor. It's introducing a new element. is Lombardelli's view going to align with that of Ben Broadbent, who decided to hold rates? So we could see a shift there. Again, one vote alone isn't going to be enough to swing the balance, but we might see that shift. If it's not August, then I mean it's almost a shoo-in, providing nothing untoward happens to the economic data and the inflation takes a spike again. But I think it's almost a given that we'd see it in September. But personally, I feel that rates, economic data, everything has kind of aligned itself to support a rate cut. The market's crying out for it, the industry's crying out for it, and consumers are crying out for it as well. So longer term, I think rates by end of year sitting at 4.7, 4.5 makes sense. And as I said, if the economic data does support such a cut, then I think that's where it will be. 4% is a little bit down the line and a difficult one to forecast, but I certainly imagine if things continue in this current trajectory, then by mid-2025, if things are going well, then we will come back down. But any hopes of going back to a near 0% interest rates are extremely unlikely. I mean, I don't think that we're going to see for many, many years, if at all, back to that kind of 0% interest rate environment. The neutral rate is that much higher now. So I do think that we'll probably land somewhere in the region of 2%, and that's where it will kind of bottom out and settle. But yeah, again, stranger things have happened, and we can continue to monitor and assess and have conversations with clients about what impact that will have on markets. And as I touched on earlier, the inverse relationship that it has with bond markets means that, is it now time for us to reevaluate and look at bonds? Where in the end of 2021, we were talking about cutting exposure into bond markets and reducing that risk because we were certain that interest rate hikes were on the horizon and that would have a detrimental impact to the bond market as a whole. Now we're perhaps looking at from the other side of the screen, and we're starting to think, well, actually, is now an opportunity for us to increase or continue to hold that bond exposure that we've had and see the increase based on rates coming down. So yeah, I'm certainly excited for that prospect for clients to benefit from that.
Yeah, absolutely. I mean, about the interest rates there, it's a bit of a mixed bag, isn't it? You know, there's arguments for and against, and that's certainly where we can see some movement in the FX markets. I mean, Jake, let's just turn to you on that sort of topic again of the interest rates and changes globally. I mean, Lewis has sort of touched there on the bond market. How else does that affect sort of cash and equities? What are the sort of forecasts there on financial markets from these interest rate changes?
Yeah, so first of all, just again, it's important to look at the central bank. So as Lewis mentioned, the Bank of England is likely to lower interest rates. The European Central Bank has already lowered rates, and the Fed is 100% priced in September. So if you break down the three main asset classes that people have their money in, you've got equities, so stocks, you've got bonds, and then you've got cash. So equities, they're going to benefit from interest rates going down, because if rates do come down, it just means it's cheap, that there's cheaper money. So people that have money are going to put their money into assets where things are going to grow. So you get something called asset inflation. And this is something that people sometimes fail to really understand, because if you take into account COVID, for example, 2020, a lot of analysts were then expecting that markets would completely tank and it was going to be the Armageddon of the world. And stock markets, fair enough, did tank for a couple of weeks, but then finished the year completely breaking new records. And the reason for that was there was a big disparity of wealth. So the rich got more money, and if they've got more money and interest rates are really low, then they're just going to put it into assets which are going to grow. And if you're comparing equities versus bonds, equities in the long run is going to perform better than bonds. So lower rates floats all boats. And then if you think of bonds, as Lewis also mentioned as well, if rates come down, then yields come down, and if yields come down, it pushes the price of bonds up. So again, if you think of buying a bond, let's say you put £1 million into a bond and it paid a 5% coupon for 10 years. If you held that bond to maturity, yes, you get the 5% coupon paid out every single year and you get your capital back. But when you're buying bonds in an investment portfolio, it works a bit differently, because bonds trade on the secondary market. So if, for example, there's expected rate hikes, then it absolutely tanks the price of bonds, and vice versa. If rates are expected to come down, then it will push the price of bonds up, because people are buying and selling from these funds all of the time, which means they have to show the secondary market. And it can be quite confusing to fully understand this, because equities is quite easy to see, because if a company does well, then the price of the stock goes up. But bonds is a bit more complicated in that sense. But then if you think of cash, if rates come down, it's just negative for cash, because the actual yield interest that cash produces is just going to go further down and further down until rates eventually stop, and then they'll hang around that rate. And there was a study done by Vanguard, one of the biggest fund managers in the world, and they looked at where asset classes went 12 months after every single time the Bank of England, the interest rates peaked. So for equities, it was mixed, and the reason it was mixed is because it depends on the scenario. So at the moment, we've got a potential soft landing, which means that the equity market shouldn't be as affected. But during the financial crisis, it was potentially going to be the brink of collapse for many economies around the world, especially the US was on the verge of collapse. So in that scenario, of course, it impacts equities a lot more. But for every single scenario where Bank of England's interest rates peaked, bonds never had losses for the following 12 months. And the average return was 10%. So if you compare that to equities, equities holds more risk, holds more potential for growth, but bonds, and this is not financial advice, it's not to say it's definitely going up, but based on past performance, there hasn't been any period where it's gone down. And if you think about it logically, it's because bonds are a bit more of a mathematical equation based on interest rates, and interest rates can be affected based on the economy. If it gets downgraded, it pushes yields up. That of course has an impact as well. But if rates come down, it pushes the price up, and we can see based on the Vanguard study that that's what's going to happen. So what I have actually done just before this webinar, I looked at 10-year US Treasuries from 2007 to 2011, and the reason I took that period is because the US started lowering interest rates in September 2007 before the financial crisis, and then they finished in December 2008. So it took them roughly just over a year to lower rates. And in 2007, the 12-month return was 10%. 2008, it was 20, so a 20% return on 10-year bonds, extremely high considering it's such a low-risk asset class. 2009, it was a minus 11% return, and then it was 8, and then plus 16. So over a 5-year period, the cumulative return was 43%. Extremely good considering it was only in 10-year government bonds. Take the S&P 500, completely different. So 2007, where markets were still strong, it was up 5%. 2008, it was negative 36%. Now, a negative 36% return means you have to achieve 50% roughly to get back to square one. And in 2009, it went up 13%, then it was 2%, then it was 16%. So over those 5 years, it was still down 16%. So bonds are up 43, the S&P 500 was down 16%. Very, very different returns, but it just goes to show that you shouldn't have all your money in one asset class if you are, for example, if you are retiring over the next few years. If your time horizon is way further into the future, different scenario. And what that doesn't say is, right, well, if that happened in 2008, then why don't we plan for that and put everything into bonds? No two scenarios are going to happen with equities. So we need to just look at what the current scenario is. And the reason bonds sold off so much was, as Lewis mentioned, interest rates went up so rapidly. And it was an awkward conversation that we had with clients, because we were telling people to increase their asset allocation towards equities because we knew bond yields were going up, which were going to push the price of bonds down. But in the scenario today where we have a potential soft landing, all of the economic data is quite positive. Not all of it, but the majority of it, which means that you don't really want to be changing your asset allocation between equities and bonds based on where you think interest rates are going, because in theory, most of it's already priced in. But I think for bonds, for the next 12 months, if we look at what it has done in the past and we assume that we potentially could get a 10% return, we already have seen a 5% return since October, where interest rates for the first time were priced in at 0% to go up in December. So that was the bit on equities, bonds and cash. But then I guess from a currency point of view, Johnny, was there anything you wanted to add?
Yeah, absolutely. I mean, thank you very much for that analysis. I think that's really helpful, and just breaking it down to some of the basics, but then doing the deep dive. I wonder what that money invested in the S&P in 2007 would be worth today, though. Like you said, over that longer term period, you do see those improvements in the stock market, don't you? So don't worry if you don't have the numbers to hand, Jake, but I'm guessing that would be quite attractive.
I know the number since 2000. I think it's roughly about 300%.
Incredible.
There was the period from 2002 to 2012 that they called the lost decades, where the S&P 500 actually produced no return at all. So then you compare that to 300% for 2000 to 2024. It's just such a big difference, and that's the importance of being invested throughout periods of markets going down and markets going up, and not trying to time the markets, but actually having more time in the markets is the expression.
Absolutely, and it just shows the importance of being in touch with experts who can help manage all of this for you and guide you in the right path. So no, thank you. That's really, really interesting. And you're absolutely right. From a currency perspective, interest rates are absolutely key. Interest rates are actually one of the key drivers for movement in the currency markets. Very simply, a higher interest rate makes that currency more attractive from an investor's point of view. Investing in the bond market, as Jake and Lewis have talked about, where investors will have to convert into that currency to then purchase bonds, government assets, and you can see some big changes around the time of interest rate decisions, where the market, you'll get your sort of short-term speculative traders just buying and selling currency on those shorter term expectations of where the currency markets could be headed. But you'll also get your more institutional, certainly the longer term investors in perhaps the bond market, your pension funds, perhaps some of the hedge funds out there, large institutional investors buying up very large amounts of currency or investment for the longer term. And that's why the currency market's one of the biggest markets in the world. It is the biggest financial market in the world, the FX market. That's why it can be so volatile, because there's so many different interests here. And so, as I say, generally speaking, a higher interest rate means a stronger currency. When markets think the interest rate is going to come down, they'll sell off that currency and then look to invest in a higher yielding one to get those higher returns. And so both Lewis and Jake talked about these lower interest rates that are being forecast. Once that becomes more and more apparent, the market will sell in advance, and we'll talk about events being very much priced in. I will get that quite a bit sometimes with clients, where we'll be coming up to an interest rate decision and the news is largely priced in, and everyone's almost expecting there to be some big jump. We saw it quite a lot with the Bank of England interest rate decisions. Actually, they were raising interest rates last year, and the pound actually was a little bit weaker after those news stories, even though, say, in principle, you'd get a stronger pound after the interest rate decision with interest rate being raised. The currency markets had largely priced it in. These central banks often want to have very clear communication to the market, so they'll make it clear what they're going to do, so they don't get accused of misleading the market, so that financial markets are a little more stable. But yes, the general principle does apply. Higher interest rate, stronger currency; lower interest rate, a weaker currency. So the outlook, as we've discussed, certainly the Bank of England 50-50 chance for August. September cut. If the August one doesn't happen, then looking quite likely. Perhaps another one before the end of the year for the UK. For the Eurozone, they've already cut once, as we've mentioned. Their next cut was almost announced last week for September, but they've really left the door open to further cuts or not down the line. It is anticipated there will be some cuts that they may have to look at because their economy isn't performing quite as well as some of the earlier forecasts. And then for the US, I mean, the forecasts have really been very up and down. They've had a really good year. The US economy is performing very strongly, some very good growth numbers. But there are still the expectations of the cut for September, and then perhaps another one, maybe even two before the end of the year. So we did see in the chat box a question. I talked about the pound-euro forecasts, and that always gets a bit of interest from our audience when we start talking about the numbers and where currency could be headed. Someone asking about the dollar forecast, so I'll just summarize those. So if we're taking the sort of market interbank rate, we've been up towards 129. We have hit 1.3, which again is some of the highest rates for pound dollar in almost a year. Just shows how strongly the pound is trading, almost a 2-year high on pound euro, a 1-year high on pound dollar. 3-month forecast though takes us down to 126. 6-month forecast back up to 127, and the 12-month forecast back to 129. So really that's based on an expectation that there's going to be a lot more interest rate cuts coming from the US sort of further down the line, but in the shorter term perhaps some more from the UK. That's how we can sort of summarize that. But really these forecasts are changing all the time. Last summer, the Bank of England were themselves forecasting that rates could go up to 6.5% this year. That was last summer being forecast. Of course, they're at 5.25% at the moment. And of course, the next leg is likely to be lower. So even the central banks themselves don't quite get these forecasts right. And again, it's why it's so important to be in touch with people like us, Lewis, Jake, and myself, just to understand not only what those longer term forecasts are to shape your sort of longer term outlook, but also to understand when we're getting the changes, when we're getting the latest economic data, which will influence exactly where those new forecasts could be headed. And that's certainly what we'll be able to share with you. Right, moving back, some tax questions, which of course my two panelists are experts on. Lewis, I mean, we touched on it earlier about the non-dom status. I know Jake had mentioned it, but just to run through it, we had a question on sort of the impact on capital gains, inheritance tax, but also pensions. Anything else we didn't cover before that we need to mention there following the election?
Yeah, I mean, there's going to be changes and shifts to taxation. Jake, residency tests. He talked about, obviously, if you've lived outside of the UK for a consecutive 10 years, then there wouldn't be that taxation on worldwide assets. I mean, if you're returning to the UK, you would benefit from a 4-year tail whereby you wouldn't pay tax on worldwide income. So that's something which, if it does come in next year in 2025, that people making a return to the UK might consider. But again, it pays to consider whether you do have plans to return to the UK and remain there, or whether you're going to go back for a short period of time and then leave again, because that 10-year clock would restart. Yeah, so I mean, UK resident non-doms, so people living in the UK who are not UK domicile, they're going to see that they're going to be taxed on worldwide assets and income, including in death. So that 4-year tail, it kind of time spent in the UK already would already be counted. So if you've been a UK resident for 3 years, the change comes in from April 2025, then you might be able to benefit from just 1 year exemption of those worldwide income taxation. But yeah, if you've been here longer than 4 years, then you wouldn't actually receive that benefit, and you would be taxed on the income of assets globally. Capital gains tax, I mean, that is something which both Keir Starmer and Chancellor Rachel Reeves have said that they've got no plans for an increase in capital gains. But I mean, it was a massive notable omission from their party manifesto that was released in June. So it's an area that could be revisited. I mean, it's low-hanging fruit for a tax grab, and we know that the country does need to raise money. There is concerns that economically and kind of the money that we have in the coffers is running low. So are they going to kind of put that back on the table for discussion? Currently, higher rate taxpayers, you've got 24% capital gains tax liability on residential property gains, 20% on other chargeable assets. But an increase or an amendment to this might bring it in line with current income tax thresholds. So, I mean, you could see a significant impact on investors or landlords that have seen personal allowances already slashed to just $3,000 per year. So this is almost a double whammy. This could be something which significantly increases their capital gains tax liability, and certainly something that needs careful planning and consideration I mean, are we going to see people increasing the sale of properties if there is a projection or a forecast that they're going to raise capital gains tax in line with income tax thresholds? People might try and get rid of property portfolios quicker, pay the lower amount of capital gains tax, and then just not worry about their property portfolio anymore. So we could see a really quite serious impact to the wider market. The pensioner impact, I mean, look, both Labour and Tories were talking about triple locks. Tories were going one step further with a triple lock plus, but I think Labour will stick to that triple lock. So they will continue with it. It's got its critics. I mean, look, there is a concern that the rate is fast approaching the personal allowance for income tax. I think it's 2027. The forecast is that we might see that state pensions are taxed as income. The other thing that's notable on that fact is that Labour actually opted out of unfreezing the current income tax band thresholds that were put in place by the Tories. So again, if they're not going to remove that freeze and increase, so I think the increase would have taken by now, the personal allowance would have gone up to about 15,000 and the higher rate threshold would have gone to 60,000. So, I mean, that decision to not increase has created some problems. So are you going to be faced with a future where you're drawing down a state pension, but that state pension amount goes above your personal allowance, and then you have to pay income tax on that state pension? So it's quite a difficult one for them to navigate. Private pensions, that there's always speculation that the Labour Party, who are always looking at increasing taxes or finding ways to drive more money into the country, they might look at removing the 25% pension commencement lump sum, or more commonly known as the tax-free lump sum. I personally don't see it happening immediately. I mean, it would be wildly unpopular. It's one of the few pension features that most people are aware of, they know about, they're favourable towards it. But if the state of the economy is that bad, then I guess nothing's off the table. But I think I touched on earlier, the more likely change that could be made, or the more obvious amendment, would be to look at the lifetime allowance, or the lump sum allowance as it's now called, and that is the lifetime limit of cash, tax-free cash. So 268,275. Do you reduce it? Do you amend it? Do you put a freeze on it? Do you do something with that? So I think that's the more likely area that we would see the impact being felt. I don't think that they would remove, after such a landslide victory, it would be really poor choice to then go and upset the apple cart and upset all of those voters that have gone and put you in power by removing something which is so coveted. But yeah, I think we're going to see more information on that in the budget, and that's really where we're going to get a bit more meat on the bone and a bit more information that we can then inform clients and talk to them about how we then build their financial planning around those changes.
Fantastic. Well, that's brilliant. Thank you, Lewis. Well, unfortunately, audience, we have run out of time. We had a few more questions to get through, so I'm sorry we have reached the end of the hour. One of the questions, very quickly, I'm just going to put to you both. It was asking when the budget is. I think we're going to try and have another webinar anyway before then, but are there any dates just yet? When's it coming? When's the...
Good question. At the moment, it's uncertain. So Labour will announce the budget. So Rachel Reeves has, she came out a little while ago and stated that she wouldn't be putting forward a budget until the Office of Budget Responsibility had done an assessment to see how the spending plans would affect the economy. And if you remember back to late 2021, we had the shortest Prime Minister's tenure of Liz Truss, and she failed to actually have an OBR report. And that was in part some of the reason why that mini budget between Liz Truss and Kwasi almost crashed the UK economy. So I think it's sensible that she waits for that OBR report. She has a look at budget responsibility, how the spending would affect the wider economy, what's going to happen with that. And an OBR report takes around 10 weeks to put together. So I think the earliest that we'll see Rachel Reeves put forward a date or announce a date would probably be mid-September, although we may just see that it's kind of pushed back to October. So yeah, certainly September, October a late autumn budget is what I would expect to see from the Labour Party.
Another example of the measured approach, which has so far sort of soothed markets from a UK perspective. No, thank you, Lewis. Well, as I say, that's all we've got time for. I'm just going to pass back to each of you for just a quick outro and maybe just a quick takeaway before we leave you both tonight. So, Lewis, if I just come to you, please.
Yeah, certainly. I mean, underlying takeaways. Elections don't really rock markets too much. The Labour Party was widely expected to get into power, and the areas that we expected to see movement, such as UK housing sector, have seen positive upswings. FTSE 250, domestic market, positive upswings. Outside of that, we're more focused on Bank of England, Fed, ECB cutting rates. When's that going to happen? What impact is that going to have on markets? But realistically, for clients, what they need to focus on is remaining invested, having a well-diversified portfolio, and having the ability to talk to financial professionals like us who can help them with circumnavigating some of the changes that are likely to come into effect, but more can be understood and become clear when we see the budget announcement and what changes that's really likely to bring to investors, savers, and the wider economy.
Excellent. Yeah. Thank you very much, Lewis. And over to you, Jake. Thank you.
Yeah, I agree. All I would add on top of that is you can't plan for something that hasn't actually happened, but you can plan for what you think potentially could happen by having an option A and an option B. So when things do actually change and they are actually implemented, that's the time to actually look at what your current structure is, what you could do, and then speak to a professional like ourselves to see what the options are, because our job is to make sure you understand what has happened and what you can do so that you're making the right decision for yourself.
Fantastic. Yeah, and similar from myself in terms of speaking to the experts just to fully understand what is happening from a currency perspective. It's a great time for sterling. Pound, say, trading at 2-year highs against the euro, 1-year high against the dollar, and it's up against most other currencies. And if you're buying sterling, you know, if you've got overseas investments, obviously that could play a real factor for you. Obviously, you want to see the pound coming weaker. With some of these interest rate changes expected for the Eurozone, the US, and of course the UK, there could be opportunities. So yeah, very important, as the gentlemen have said, to be in touch with the specialist. So thank you, audience. Thank you very much for attending this evening. So there will be a video that goes around. You'll be able to contact any of us individually for more information. But yes, that's all from us. We'll certainly be back with more of these in the future. We hope you enjoyed the evening, and we look forward to seeing you all again in the future. Thank you very much, everyone.
Thank you. Bye.
Thank you. Bye-bye.
Good evening.